Welcome back to another Market Insight Call, joined as always by Aaron Tuttle, our CEO. It is 8 a.m. on November 19th before the market is open. It's been a tough month. Markets are down 4, 5, 6% since our last meeting. Let's just go through it. We'll hop in it pretty quickly. The too long didn't watch version would be there's been a short-term Fed pivot of maybe not going to cut rates aggressively, which led to some bank stress issues. There's big credit cracks in the private credit market. We recorded a video that we'll put at the end of this with an insider into the credit markets. And just overall AI jitters kind of pulling to a little pullback. We think it's short-term noise and we'll set up for a nice rally into the end of the year. And that's really what we want to cover.
Well, if this is a too long did not read or listen, because you are watching it on YouTube and you would benefit from listening to it on your car, while you're down there, hit that subscribe button, go down and look at our notes and join our Spotify channel so that you're able to do it. And make sure that you are subscribed so you get the notice for next month, who Jeremy Siegel is going to be joining us. He tells you why you should buy stocks. And he's, I would say, right up there with Milton Friedman as just name recognition, at least in our world. So make sure you subscribe and hit that like button and share it with your friends.
We haven't looked at an S&P 500 chart in a few months, so figured we could frame it with where we've been. This goes back to the April lows, and we put none of our own expectations in this. It's just saying from the absolute low, that's that green bar I drew in the middle, to the top of where we topped out a month ago, up almost 40% from the lows. So to see a give back 5, 6, 7% is normal. I hate when people always say it's a healthy pullback.
I would say it's a healthy pullback.
I like 3 to 5% is healthy. 5, a little more than that is.
5 feels a little bit rough. It does for sure, but that's when you set those foundations and you're like, no, we've tested this.
Exactly, and that's what we're seeing. So then we see the S&P come down at the far right, top right of the graph, and we broke through the 50-day moving average. So what does that tend to mean? Forced sellers. Like the 3 to 5 pullbacks is what we've had all throughout this chart, and never broke below that line. So they didn't have that forced selling to keep triggering lower markets. Well, we hit that, this week. And we can look below here to the RSI, something we pull frequently to say short-term bottoming. And throughout this period of the pullbacks, we've seen those 3 to 5% pullbacks. We never got to the washed out 30 RSI, which is, you've always said, the close your eyes buy signal. We haven't got there yet. So this is just the setup of the market. We added in our own annotations here. Now we drew a line, this started earlier in the week, where we said, just based on how we saw markets trading, we thought we'd see continued downside, which we have seen through some of those technical breaks. And I think we bottom out here, another 1, 2% down, and set up for a great end of the year rally that would be consistent with a lot of the things we'll talk about, and consistent with some of those quant metrics, and predicting if you do get that sell-off, you will see that washed out 30 RSI. We said one of the first issues that started to peak a month ago was this pivot in the Fed. At the last Fed meeting, it was pretty clear they wanted to pull back expectations of the market rate cut. And the best way of seeing this is the small print in this chart on the bottom right, saying a month ago, there's a 93.7% chance that the market was pricing in a rate cut at the December meeting in a couple weeks here. Well, now it's 50%. So the market had to pull back some of that optimism. It's one of the things I'm getting tired of saying, that we've been consistent saying, we're in a rate cutting cycle. We'll continue to see this, whether they cut at this meeting, the next meeting, or after that. We still think rates are coming down, and that will be the message. They just wanted to pull back one meeting.
I think this answers all the jitters in the market. Yes, there's AI jitters that we're going to talk about, but we had the sell-off, and it was driven by this number, right? The Fed is anticipating slowing their cuts. That means you have to reprice all your models for interest rates just remaining the same. You see a sell-off, lasts a day, and then we kind of bottom out, and then we're moving up. There's nothing that's really changed in the economy other than just what the base rate is for capital market projections.
And that's a good point too. People want to point to the AI issues, and some of the stocks that are up 200%, the quantum, crypto, those are getting killed in this. But when you're looking at just general basket of stocks, you'll see, like you said, a lot of them moving down together, and it's not just the AI stocks. So you can point to a day or two where AI is down and the rest of it's not, but to the most part, I think you're right that it's the bank funding, which is we'll talk about here in a second. It's the rates.
Right. Those things should be correlated. There's definitely frothiness because of all of the projections built in AI. But when you cut interest rates, you're discounting things further out in the future. And the ones that haven't really gotten those earnings that are being projected that are really high, it's going to have a much bigger impact on their stock price than others. So I think that's consistent with what you would expect whenever you just see a slowdown in rate cuts.
And it's saying the same thing slightly differently is the Fed has also been pulling liquidity out of the system for the last 2 years with quantitative tightening. So they're pulling cash out of the system. You can look at that in many ways through reserves or SOFR rates that we've pulled. And that's simply to say, and they're watching it very closely, is that if reserves get too tight, there can be some issues with overnight bank lending and demand for cash, essentially. And we pulled the chart. We don't need to go into it, but it's been volatile for lending rates. Now, we don't think it's a big problem, but there are a couple big traders who said, this is what in the short term they're really worried about, and they were crediting this to some of the sell-off.
So what you would see, you see a downward trend here. There hasn't any movement. If there was an actual freeze in the market, you would see interest rates spike up dramatically. We don't see that. You would see beforehand, you would see the money supply begin to reduce, which the Fed had been doing. But when we look at the money supply now, it's robust, it's growing at a rapid pace. I don't see the setup of a credit market freeze. And if they were to do it, we've been through it before. As you said, the Fed is watching. They're going to respond. And I think 2008, they talked about bazookas. It's going to be a tank this time. So this is not something that was keeping me up at night.
No, it wasn't for me either. And that's what, in 2019, is something I remember when it was happening and rates were spiking, and we had to send something out overnight of like markets were down a couple percent, a short-term panic, and the Fed injects liquidity immediately.
Right.
Now, we know they're watching it. You listen to their speeches, but half of them are saying we might have to do it again.
They are watching. Are they watching us?
No. If that's what
They
I said,
should
that's
be.
not what I meant. And money supply growth, you referenced it. It's not where I want to see it, but for those reasons, rates coming down, quantitative tightening is going to be stopped next month. I think we can get back to the trend. The average trend is somewhere around 6%, 6.5%. We're in the 4s right now. So we're moving up, not quite there, but we've certainly based and moving higher.
We've based and we're moving higher, and I think a lot of that has just been the slowdown because of the amount of money that was injected because of COVID. So there's still just a lot of money that is sloshing around.
But what's happening? What do you think's happening to sentiment? If you're not following it, you wouldn't see it. But sentiment online, surveys, it's poor right now, which is a great contrarian indicator.
It is a great contrarian.
The market tends to bottom when.
And when I talk to other CEOs, a lot of them are saying the data looks good, but everyone feels like the next shoe is going to drop. What I think is happening here is, one, there's political bias where we have a person that in the White House that obviously has a outsized emotional impact on some people. He's an iconoclast type of figure. So that's one part of it. But I think the bigger part is that we had a lot of inflation, and that drove prices up. And we have not seen productivity gains really drive real wages up. So everyone's feeling poor, especially if you're in that demographic of 30s to 40s. There is a recession in fast casual. There's not as much discretionary income that they are able to use. Prices are higher, and we haven't seen the productivity gains that are likely coming from all of the AI. In addition, we haven't received those productivity gains. You're seeing energy prices move up. Your utility bills are going up because of all of this build out on data centers. So I just think we're in a situation where you feel poorer and you feel like we've gone through a lot. So I think that's where the emotional aspect of the sentiment is there. I think there is some legitimacy to that feeling, but I don't see that driving the price of the market down.
Well, let's look at that from a number standpoint of just overall consumer health. So the left-hand side of this chart, this is my favorite way to look at this data. Most people don't do it. They just do debt. And the debt chart looks nasty.
Yeah.
That is just increasing lower left to upper right. But if you put a denominator on it, disposable income, it looks a lot better. Now, it was better a few years ago when debt relative to income was lower. That was obviously the big injection. We saw it on the last chart with the money supply where it spiked. If you squint, it's topping out, which is great. But it's in the normal range of where we were in 2015.
And this one's, it's not so much debt as it is debt service. So the other impact that's going to be driving that up is we do have higher interest rates. But to your point, the disposable income, despite it not being as robust as it was prior to COVID, is there in a sufficient and relative manner to the amount of debt that we are servicing.
Mm-hmm. And especially with the backdrop of rates coming down, that's helpful. And we can look on the right-hand side, which I think is a lot of what you referenced too. 3 of the 4 have topped out. And this is a delinquency measure, and there are reasons for why delinquencies are down, some technical reasons that maybe are overstating how good this looks, but some of them are down, with the exception of student loans, which had a huge spike, obviously, when there were some delays in having to pay them. Now they are. And you kind of referenced it, what's getting called the K-shaped economy, where those that are really struggling are struggling, and some of their debt had increased, and the student loan delinquencies are up.
I also believe reversion to the mean, and you see where you had all those debt payments stop, and now all of a sudden you're going to have some delinquencies as they reintroduce that to budgets that were not built on those payments.
Another really supportive thing was we haven't closed out earnings yet. We had one big report this afternoon. Nvidia closes out on Wednesday afternoon. It's one of those tough ones. It's always been a tough quarter because you hear from a lot of the people buying their chips already, and you know spending's up. You don't know what their margins are going to come in at, and everyone has high expectations and expects a good quarter. So it's tough to deliver for them. The numbers are probably going to be good, but how does the market react is really tough, and obviously that's known by the time this gets released. But overall earnings, 13% is what I have squared off there in green. When going into the quarter, we're only expected to be 8. So a little overstated from some of the AI things, but great backdrop of really strong earnings this quarter. Going into the end of the year, I think that's going to be supportive. And we have my favorite part of the year, which is the great technical backdrop. So we've already seen this pullback. We think it's bottoming, and in November to close out the month, tend to start to bottom next week. Really, as the 20th to the end of the year, you tend to get this 1% on average increase. So I think we're going to see the bottom. We'll get back some of those losses, can get 1% from November, and then another 1.5% in December to get back to new highs. Is really our base forecast. Same thing, a little choppy at the beginning of the month of December. Close out the year really strong. I know it's a lot. One final Santa Claus rally, which we talk about. Often we say Santa Claus rally is December, but the real technicians use the last Christmas, the last 5 days and first 2 of January as your technical metric. On average, 1.3% up.
I think that goes with, my parenting is that whenever I was a kid, Christmas happened after Thanksgiving. If you ask my kids, Christmas starts before Thanksgiving, so why shouldn't the Santa Claus rally start before Thanksgiving now?
So really to summarize, difficult short-term period for the markets. We think we enter a great backdrop to close out the year. And we went deep in the weeds on the big headlines of private credit and just some of the other issues in loans right now. And we brought in insider Andy Mark. I love bringing on people who can really, if you brought in a private credit analyst, they're just going to say everything's fine. They cover just private credit. But when you can cover anything within credit, they can say, and he could point and say he likes treasuries the best, and he's actually seeing how these deals are getting funded and some of the issues and some of the good things in credit. So I think we got some really good summaries of, he's not just saying that everything's fine, that there are issues in private credit, but the summary would be that we don't think it's systemic, not going to take down the market, but there are certainly some issues within the debt markets.
All right, Andy, let's start with the main headlines, really what's happening. I'm seeing a lot of headlines that are mostly talking about private credit issues, but a lot of them are actually started in the public markets. What do you think's going on?
Look, I think, as we look at what's happening today, you're seeing a return of cyclicality in credit. Markets are crowded. You've seen issues percolate on the public side. You've seen, I think, under the surface, some issues percolating on the private side that are pointing the way towards an environment for credit risk taking that requires, I think, a heavy focus on risk management. And re-underwriting things, making sure that everything is buttoned up tight. I think you're seeing a need to focus on value, right? A lot of the discussion in credit over the last 4 or 5 years has been focused on origination. How much can you originate? How do you originate? And I think it's been less focused on, how do you ensure that you're getting the strongest risk-adjusted returns? How do you think about value across sectors? And so I think that's sort of what you're seeing kind of percolate at a high level.
So what are really the main issues? I mean, you're describing a period of time where people are just being really competitive, right? Probably pricing loans too aggressively at rates below what they should be, given expected loss rates or loss rates coming in higher than expected. So just want to know how you're approaching, where we've been, but also I'm still seeing pretty competitive loans when people are going out and pricing them from what I'm hearing.
I think that's right. The credit markets are priced at really tight levels, and we can look at the public markets and see high yield trading at levels that are close to the tights over the last roughly 20 years. You're seeing investment grade trading at some of the tightest levels than we've seen since the late 90s. And on the private side, you're also seeing a significant amount of spread compression. I think what that means is you can make good money in credit, and the relative high level of base rates compared to several years ago means that there's good returns to be had, but you have to be really, really dialed in to the type of credit risk that you want to take, to where you want to be in the capital structure, to the sectors and industries that you want exposure to, because the other thing that I think is important that we're seeing is, between public and private markets, spreads are converging, but liquidity is not, right? The public markets remain more liquid. And, I think for a lot of opportunity today, many investors would probably benefit from staying flexible in liquid credit, given what's been a pretty constructive environment for fixed income credit. And ultimately the higher cost of locking up capital today.
But how are you approaching it seems like every day fraud is typically to blame, but how much fraud is actually in the system for these loans, and how you guys would be approaching that? Because it's at the same time where you keep seeing headlines, and I'm wondering if 6 months ago these things were happening and you just weren't getting printed on Bloomberg every day, because now it's the thing to talk about for clicks. So are we significantly above trend on defaults and loss rates, or is it just headlines?
Well, if we look at the direct lending market and the BSL market, I think it's important to remember that defaults are the easiest statistic in the world to manipulate, right? If I'm a lender, the only way that I can have a default is if I call a default. And so, I think that, when we just focus on the default rate, we end up missing, I think a lot of what's happening under the surface. Lincoln does a great job of reporting sort of a shadow default rate for the direct lending market that incorporates PIK or payment in kind. And to be fair, PIK is a tool that lenders and borrowers can use constructively, but it's also a tool that tells you, hey, this borrower can't pay a cash coupon. There might be some bigger issues within their business. And ultimately, whether it's good PIK or bad PIK, if you have an instrument that's picking, as a lender, you are by definition taking more equity risk, which may be suitable, may not be. But Lincoln looks at things like bad PIK, where they're seeing a borrower that's showing exhibiting significant stress, has converted to picking rather than paying a cash coupon, and viewing that in a less constructive lens. As a potential instrument that could default. And then, the other thing that I think is important, to query managers about is, what's your waiver rate? How many amendments have you processed? How many times have you had to get your hands dirty and put hands on a credit? I think if you look at those, right, Lincoln is in the mid to high single digits in terms of a shadow default rate for direct lending, incorporating some of those other perspectives. And I think that's broadly where that credit should be today, right? Fitch looks at the middle market writ large across the CLOs and the direct lending market, and their view of the credit quality in the middle market today is an average, mid to low B. That tells you that if that's the average, there's probably a good bit of triple C risk that's in there. And what we know about single B and triple C credit risk is that it defaults pretty regularly. We have 40 plus years of data on how that credit performs across different cycles. Triple C's probably show 3-year cumulative default rates in the 25 to 35% range historically. So direct lenders that are reporting default rates of 1 to 2% are probably masking somewhat a lot of the challenges that are going on underneath the surface within their portfolios, within some of the BDCs, and I think we see that.
So how do we extrapolate this out? Jamie Dimon's calling them the cockroaches, and there's more of them. And then Muhammad Al-Arian saying, yeah, they're cockroaches. They're not termites. They're not going to take down the system. There's just going to be a handful of them and keep going up. Where do you side on that?
Look, I think you're seeing activity that is illustrative of kind of where we are in the cycle. You've probably seen some lenders reach into pockets that were a little bit riskier in an effort to either deploy capital or to generate returns. You've probably seen people accept more risk. One of the issues that we've seen with a lot of the receivables financing and the purported fraud that's happened in that market were related to some simple risk management procedures, like not allowing a borrower to self-custody assets. Those are some of the parameters that are hard lines for us. Other people have probably taken a riskier approach, and you're going to see people that have losses from that. I wouldn't take some of the idiosyncratic things that have happened over the course of the last several weeks and try to extrapolate that out to this market is fraudulent or there's a lot of fraudulent activity that's happening. It's always the case, and as lenders, as credit investors, we need to be really thoughtful about the likelihood and the possibility that can happen. But it is illustrative of the fact that you're seeing more cyclicality come into these markets. You're going to see economic growth, not as robust as it was several years ago. That's going to create challenges for a lot of borrowers. That's going to expose people who were maybe engaged in some kind of activity that now they can no longer hide behind. So I think credit investors are well served to pin their ears back, and look really hard at their portfolios today. Ask hard questions, if you're an investor of the managers that you're working with, and then on new dollars going out the door, just be really diligent about the terms and the protections that you put in place to safeguard that capital.
So where does that summary take you in terms of allocation?
So we have, I think, a pretty interesting view in that we're active across the wider lens of private credit, right? Private credit, I think, oftentimes people naturally think of it as middle market direct lending, but it is a much bigger market than that. There's a market for consumer finance, residential mortgages, consumer lending. There's a market for tangible asset financing, equipment finance, aircraft leasing, things of that nature. Real estate debt is a big part of the private credit market where the banks are active as well as private capital participants. And so when you can take a wider lens on that market, I think that investors are always best served by having diversified portfolios that don't key on a single factor to drive the returns, but also, give them a wide enough berth to put capital to work, in a diversified way. If you could get a comparable level of return without taking kind of concentrated risk in a specific sector, I think you'd do that all day, because diversification is the closest thing there is to a free lunch in the industry. To that end, I think we've wanted to stay away from some of the crowded areas of the market where you see significant capital that's been raised over the course of the last 1 to 2 years. And here specifically, I'd call out kind of the middle market direct lending market. That's a market where you're seeing difficulty deploying capital, competition coming back into the market from the banks. And I think spreads are relatively tight. If you could pivot into areas where there's less crowding, where you have more pricing power, there's been a lot of negative headlines, I think, around pockets of the consumer. But one of the things that I think we've been pleasantly surprised by is an actual positive inflection in consumer credit performance over the course of the last couple months, particularly for prime borrowers. There's been a lot of challenges in the subprime auto sector that have been laid bare through the tricolor and other issues. But that's a consumer market that I think we're really constructive on overall, if you have the tools and the knowledge to underwrite the credit risk through the cycle. I think it's really important in private markets to have active management, right? I mentioned earlier this focus on origination that we've seen across a lot of our LPs and a lot of our shareholders have met with managers and gotten to know managers where origination is where they start. I think we start with value as the lodestar, and active management I think is essential to navigate the challenges that we're seeing in the market today. Right? If there's a return of cyclicality, you need someone who's got a wide enough portfolio or a wide enough opportunity set to pivot where there's better value. I think you've seen more passive or passive-like strategies in the regular way lending markets that look more like beta manufacturing rather than credit selection and alpha orientation. And hand in hand with my view that relative value should matter now more than pure origination volumes. I think active management is essential to navigate the challenges that we're seeing in the market today.
So Chris is on record here with a Santa Claus rally. We're going to stay tuned and make sure that happens. And if not, we are definitely going to be available to talk about that. That may be a great conversation with Siegel, who will tell you stocks for the long runners, always the winner. So we're really excited to have him on. Make sure that you have subscribed so that you don't miss that video.